Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update. It's been a volatile one. Things are going crazy in the markets. I'm going to explain exactly what's going on. I'm also going to cover some new products, some great guaranteed interest rates that we're seeing out there in the marketplace, and more importantly, I have a product now, and it's only temporary, so you got to move on it very, very quickly. I'm going to talk about it in detail in this market update, and it's a way that you can actually beat the S&P 500. This is kind of what all of the financial advisors and analysts and everyone says, hey, it'd be great if you could just beat the S&P 500. I have a product that's available right now that is guaranteed to beat the S&P 500 on the upside, so look out for that. Obviously, we've been seeing a lot of volatility in the stock market. S&P 500 down over 10%, the NASDAQ down over 20%. Now it's recovered some of those losses more recently, so that's positive. But a lot of the economic data is still pretty weak, and we're still seeing a pretty expensive stock market. Looking at the stock market valuations based on earnings, which are now starting to come down. We're seeing a lot of companies announce earnings revisions or guidance that's not as good. We're seeing a lot of data from a lot of companies saying that consumers slowing down spending. So this is concerning. There's a lot of weak economic data. Of course, the big one is the GDP. We got a negative GDP print, so that is a big concern. Just recently, we got, actually today, a jobs report that was actually pretty good. It said, oh, the jobs market is doing better than expected. We got more jobs out there. But again, look beneath the surface. The jobs report, the headline looks good, and this is very reminiscent of what I saw out of the Biden administration, the entire 4 years that Biden was president. And essentially you see these great headline jobs reports, but then you get revisions. Down the line, you get revisions to the data. There's actually less jobs than they said. So this report looks good, but internally, if you look at what they call the birth-death model within that unemployment report and the employment report that's out there, the numbers don't look so hot. In fact, the guesstimates that are built into the model are more than double the actual jobs. That does not make me feel good about the data and what we're seeing out there in the marketplace. So of course the big concern is the negative gross domestic product, and this is a report that is based on 3 months ago. So 3 months before all of the tariff stuff has been coming out. So we obviously have an economic problem going into these tariffs, and so we got a negative GDP. Well, one of the concerns is if you get 2 quarters in a row of negative GDP, that can be when they trigger a recession. Now we had that during the Biden administration, and they did not call a recession. I think a lot of that is political, but this time around, if we get 2 negative GDP prints, we'll probably have the official recession called. And that's just psychological. You can have a snowball effect where all of the economic data and everything starts to exponentially kind of unravel. You start to see more unemployment, and these are some real concerns. Now, this is the GDP prior to the tariff talk. Well, the tariffs have created a lot more problems. This is kind of like the straw that broke the camel's back. We now have the tariff chaos that we're seeing, and it is chaos. You're seeing a lot of tariffs up and retaliatory and a lot of heated rhetoric. And of course, we have a Federal Reserve that doesn't want to accommodate some of the tariffs. And so, for example, a few months before the election, you saw the Federal Reserve cut interest rates by 50 basis points, unprecedented cut, because they clearly saw some major economic issues with the economy. Well, the data we're getting now is a lot worse than it was back then, and we haven't seen any cuts. They're not cutting. So it doesn't make a lot of sense. It feels very political. But when you start to look at these negative GDP prints and the combination of tariffs, this is a real problem. The tariffs are a problem. If this continues with the tariffs, I want you to really understand what can transpire. We're already seeing a massive, massive drop. All of the shipments coming out of China, all of the containers, they're empty. They're not, I mean, the level is just way, way down. In addition to that, you have all the truckers in the United States. Their orders are coming way, way down because the goods aren't going to get here, so they're not going to need to be shipped on trucks. And if you take this out a few months, You're looking at June and a situation where we have empty store shelves in the United States. All that stuff that's made in China, I mean, half the store of Walmart's probably made in China. I don't know the exact numbers, but that creates a lot of empty store shelves. And so this is obviously an issue here for people in the United States. It's going to create price inflation. And again, I said price inflation, not monetary inflation, two separate things. We talked about that in a previous video. But the price inflation in the stores causes us to pay more for things. Obviously, if we have to buy something that's made in America when we could have got it in China for a lot less, this is going to create a lot of higher prices in the stores. But I think it's even a worse problem for China. In fact, if you look at the numbers, I think the people of America can stomach not having Chinese goods or just not buying some of these things. The stuff we really need, like food, for example, we make all that here. The United States is the biggest producer of food in the world. And in fact, a lot of these tariffs that other countries charge us is on our food. They charge big tariffs because they want to keep the American food out of their markets because we're able to produce food so efficiently and cheaply. And so one of the positives of some trade talks and getting the tariffs down on US goods, it's going to really help American farmers. It's going to be a big part of the tariffs. But essentially, when we look at these tariffs, this is a real problem. It needs to get addressed. There has to be people coming to the table, and I feel like it's going to happen because when you look at China, there are all these people with jobs that are making things that are being shipped to America. These people don't have jobs anymore. This is a real problem. The United States has a problem where we don't have the goods, we have empty store shelves, but China can have civil unrest. You can have real problems with a bunch of people out of work. This is a problem. I believe this is going to bring the Chinese to the table. There will be some high-level trade talks. I believe there's going to be some positive results from that. I hope that's the case. I'm crossing my fingers that they're able to put this together. I think Trump did do what he intended to do. And if you read The Art of the Deal to see exactly what his game plan is, he likes to break things to get his way. And he asks for way more than he plans on getting whenever he's doing negotiating for real estate and different transactions he's done. And you can read what his strategies are in his book. And I think it's exactly what he did. He wanted everyone to take it seriously. So he said, let's burn down the house so they understand we're serious about these tariffs. And I hope it results in a positive, but I'm not confident. I think that this thing could spiral into something worse. So hopefully cooler heads prevail. I think a lot of Trump's rhetoric where he's calling Jerome Powell a loser and all this other stuff, I don't think this helps the situation at all. I know that's his attitude and how he tries to make things happen and get things done. But I think it can be really inflammatory for everyone involved, and it just creates a lot of stress. And we're seeing this in the markets. You see, he came out and made all these comments about Jerome Powell, and you saw the market really tank. And then I think his advisors probably got a hold of him and said, hey, you got to walk that back. That was way too much. So he came out then again with another social media post that said, I'm okay with Jerome Powell. He's going to serve his term. Everything's great. We're not going to fire him. And then, of course, the markets rallied. So this just creates a lot of volatility, a lot of chaos in the markets. We're going to have to continue to ride through this. I think you're going to continue to see this kind of volatility probably for the next 12 to 18 months. So you just have to hang tight, see how this plays out. We are positioned very well with our clients. We've got some great inflation hedges in place, and all these buffered indexes that we did have created some real protection for our clients in the markets. And so we've done pretty well considering what we've seen in the markets. Our accounts, of course, we've had some overweight to gold. We've had the buffered indexes, so it's allowed us to protect the accounts. We haven't seen the big drawdowns like some people have in the markets. But the economic data we're watching, I'm paying attention. Don't do anything crazy. Don't sell your accounts out. The mistakes are made when people get emotional and they see their account go down and then they sell at the wrong time. And then, of course, what happens? A day or two later, the markets rally and they come right back. So you got to just let this thing play out. That is how the stock markets operate. And volatility is something that is normal in the stock market. It just happens to be a little bit more volatile now than it is historically. Now, the new buffered index portfolio products that we have are fantastic for putting yourself in the right position, help fighting against this volatility, allowing you to continue to get good returns in the stock market. And just in case things go really bad, we've got some great insurance to protect us. And the new buffered indexes are really good. We have a 2-year, very similar to the ones we've had in the past. The current cap is 21.15% over 2 years. Great product. Goldman Sachs is the underwriter on that. And so you can earn up to 21.15% right along with the stock market, 100% participation. If the market's up 15, you're up 15. If the market's up 21, you're up 21. But you are going to agree to give up everything above 21.15. So if the market's up 30%, you're going to be up 21.15. In exchange, we get a 20% insurance policy, dual directional. So if the market starts going down, not only do you not lose, you actually make the inverse return. So if the market's down 12%, not only do you not lose, you make 12%. If the market's down 19%, not only do you not lose, you make 19%. You make the opposite return down to 20, maximum reimbursement of 20%. So if the stock market is down more than 20%, you're just going to get a 20% reimbursement. So if the market's down 25%, you would still be down 5%. But I would argue that's not a bad position to be in. If everyone else is down 25% and you're only down 5%, great time to invest while the markets are down. So that's a great product, very similar to the ones we've had in the past. But the other one we have, this one's exciting. I have not seen one like this in a long time. It's been a while since we've had one. This is what we call a barrier product, and it allows us to have a higher return, a leveraged return, a return greater than the index. And so in this case, it's based on the S&P 500 futures market. And if the stock market goes up, you go up with the market, but you actually get a 192% participation rate. So in the event the market is up 10%, you're going to be up 19.2%. You're going to do better than the S&P 500. In the event the market's up 100%, you're going to be up 192%. Now, this is a 5-year product, so you have to stay in it for 5 years. This is not money that you're going to need in the next 5 years. For those of you that are using income and other things off the investments, this is not what this is for. This is mostly for people that really have a chunk of money that they don't need to touch, that they want to see a really good return. They want to beat the S&P 500 guaranteed. Here you go. This is the product. It's great for Roth IRA money. It's great for people that just are younger, that have time to be able to let some of their money grow. Now, this product does have a feature for insurance. It's called a 50% barrier. So if the stock market is down during those 5 years, you actually get your money back as long as it's not down more than 50%. That's a pretty strong insurance. If the market's down 20 or 30 or 40%, you get your money back, you don't lose. Absolutely, it's a great deal. But here is a catch on it. If the stock market is down more than 50%, you take the full loss. So if the market's down 55%, you're going to be down 55%. So there is some risk on this. In the event the stock market is down more than 50% over a 5-year period. The start date on this thing, the funding date, is going to be May the 13th, so we got to get the money in by May the 13th. It's not a whole lot of time. If you're interested in this, you got to call us on this right away. We are looking for clients that can use this product, but jump on this. If you're interested, call us. We'll see if we can put this into your portfolio. It is a $25,000 minimum, and the 50% barrier, I think, is actually pretty darn good. And the reason is, there's very few times ever in U.S. history where the stock market has been down 50% on a 5-year term. If you go back and look like 1929 to 1934, we saw those kind of numbers. We were on a gold standard back then. Today, if the stock market was down 30% or 40%, you better believe the government's going to have every stimulus program. They're going to have stimulus programs you never heard of, universal basic income. They're going to be printing money like crazy. If you see that kind of a drop in asset prices, the government's going to go wild with stimulus. I think the probability of a 50% drop in the stock market over 5 years is non-existent. It's going to be a great investment. I just wrote a check for $100,000 for my own money to put in that product, so I think it's fantastic. It's one you definitely want to take a look at if you want to beat the S&P 500. In addition to the buffered index portfolios, which we think are a fantastic way to play the current volatility in the markets, we also have some really strong guaranteed interest rates. Now, if you want totally insured, can't lose. We have the multi-year guarantee annuity products. Those we still have the same rate, 5.5% on a 3-year, 5.5% on a 5-year, guaranteed interest, insured, the whole bit. However, we also have some other products available that are also guaranteed by the company that is offering those products. Now, it's not insured like a multi-year guarantee annuity or a CD or something like that, but these are products that are very, very strong, and the financial institution that is offering these products guarantees the interest. We have one for non-accredited investors. These are people that do not have $1 million in assets that pays 9%. Pretty strong return. You should take a look at it. It's an option for people. So we will be incorporating this for a lot of people in their accounts. We're going to look for a way that we can just put a little bit in there, get a 9% return. It's very, very good. Another product that we have that we like a lot is for accredited investors only. And these are the various income products that are out there that pay guaranteed interest. We now have 6 of these that are over 10% interest. And we just happen to be a really good time. We're getting flooded with great products. It seems like every time I do my due diligence and really dive in and look at these products, I'm like, this is fantastic. We can get over 10% interest and it's guaranteed by the largest home builder in America. I mean, some good stuff. So happy to chat with you about those. Obviously, those are for accredited investors only. But again, we do have some good products, 8, 9% type products for non-accredited as well. So we're seeing some really strong interest rates. And this is a way to kind of be non-correlated to the stock market. So if you have money that you're worried about in the markets, we might just pencil some of that money out of the markets and actually put it into some of these guaranteed interest rate products. So I think they're really, really good options for people. And we're happy to talk to you about those options. I know that they'll probably get a lot of phone calls from this market update, so be patient with us. Some of the stuff that we have deadlines on, like the buffered index portfolios, so that's that May 13th deadline, those people are going to take a little bit of priority for people calling in, asking about stuff. These guaranteed 10%, 8% interest rate products are going to be available. So be patient if you're one of those. We want to make sure that we kind of get the right people in place so we can get into these products due to the funding deadlines, and then we'll keep working through it. So look forward to helping all of you on some of the new products that are available. We're excited about them. So let's talk about stock market volatility. I want to make sure that everyone understands that I expect a lot of volatility over the next 18 months. I do think that we're going to see some light at the end of the tunnel. I think we're going to see some good economic results. I think there's some good decisions being made by people in leadership and also in various corporations around the country that are bringing a lot of jobs back into the United States. There's some good economic data that I see coming. Keep in mind that the economy and the stock market can be two different things. So you could actually see the stock market going down while the economy is getting better. And how does that make sense? Well, it's because the stock market, the value of the stock market, is based on the corporate profits of those companies. And if you have a bunch of companies that were relying on Chinese labor and relying on a lower cost of goods to be produced, those companies are going to make a smaller profit margin because they're not going to be able to sell those goods for as much money in the United States as they were before. And with these tariffs and the fact they might have to use U.S. labor for some of the things being produced in the U.S. now that used to be made overseas, it's going to shrink the profit margins on those companies. And ultimately, that could be beneficial for U.S. workers who now have jobs making things here in the United States. If Apple starts making all the iPhones in the United States, that's going to be beneficial to workers that are creating those in the United States instead of having those made in China. But Apple is going to have suffer losses or at least smaller profits on all of their phones because one of the input costs is a lot more expensive. So think about that. We are positioned very well. We know exactly what we're doing on these accounts. That's why we're positioned the way that we are. We understand the result of these tariffs and what can happen. That's why we're focused on more value. We're focused on dividends. We're focused on the companies that are not going to be impacted as much by tariffs. And of course, overall broad stock market performance, I think we will do very, very well once we get past the next 12 to 18 months, which could even see a recession. Once we get past that, you get 4 or 5 years out, I think it's going to be really strong. And that's why that buffered index portfolio that's a 5-year product is such a great deal. And I want you to understand, we have several people in the queue already. They want that product. I put my own money in. We have advisors that work in our office that are putting their own money in. Everyone's excited about it. So if you are interested, reach out to us. And for any reason, if your advisor's not available, if I'm not available, there are 6 advisors in this office now that can help. So just ask for someone. We can take a look at your accounts. We can figure out if we can reposition some of that. Again, the deadline on this is May 13th, and there's no guarantee that we're going to make it to the deadline because there is some maximum funding restrictions. If we start to put too much money in this thing, Goldman Sachs may say, okay, that's enough. We're not putting any more in. So if you are interested, reach out to us. It is possible that we get a similar product in the future, but these kind of numbers, 192% participation rate, this is exciting. I've been hoping to see a product like this for more than a year, and so we got it. Now's the time, I think, to act on this product. And so obviously your accounts have been doing fairly well. You probably noticed that it hasn't been too bad of a hit with the big drops in the stock market. And that's because we've got some nice positions in gold. That has really helped because gold prices have kind of hit big highs. And by the way, I do not expect gold prices to just keep screaming up. I think we will see a pullback in gold prices. It hit 3,000 an ounce, and then all of a sudden it's 3,400 an ounce. So that is a big, big move. I think gold probably got ahead of its skis, and we're going to see a little bit of a tumble from here. Now, I don't expect a big, big drop, but I do think we're going to see a significant pullback in the gold prices. Now, 5 years from now, I think the price of gold is going to be $5,000 an ounce. I think you're going to see big inflation. When you're running 7% deficits to GDP, I mean, there's no question we're going to see gold prices go up. It's just in the short run, I think those may pull back a little bit. So if you see that in some of the accounts, we're going to still stay focused pretty heavy on gold because I think inflation is going to continue to be a problem, and we want to keep those positions in place. But I do think the price of gold has moved a little bit faster than we anticipated. So good thing for our accounts, help protect us during this kind of downturn. And I think one of the reasons too why gold has moved so quickly, so fast, is I really think it's China. Now, I'm not 100% sure on this. I don't have, total guaranteed proof, but it looks like China is probably selling U.S. treasuries, and they're using that money to buy gold. And so what they're doing is they're removing out of the dollar system, buying physical precious metals. This is driving up the price of gold. At the same time, I think there's a lot of gold being acquired here in the United States. We're starting to see a real pickup. Institutional buyers, not so much the retail public. No one, the retail people, they haven't figured this out yet as far as gold price, but a lot of institutional buyers. So I think that there's been just kind of a big push here recently. We'll probably see a pullback, and then it's okay. We'll hang tight, and in the future, we'll recover that. So hope this was a good market update, and look forward to speaking with all of you. Please feel free, call the office. We're happy to help you. You can email us, support@copleyfg.com. Great place to start. Again, support@copleyfg.com. Get that email over to us if you need any help on anything. And I look forward to seeing you in our Mission Valley office very, very soon.